未来房子不值钱，大家觉得这个未来是多久？
The future of housing is bleak. How long will it take? By next year, many people will be on their knees begging to sell their homes, but they won't be able to.
In the first quarter of 2025, China's top 100 real estate companies saw their sales plunge by 47.5% compared to last year. This marks the sharpest drop since the golden decade of real estate. Land auctions are cooling, new homes are sitting unsold, second-hand homes aren't moving, and many companies are struggling to stay afloat. In the four major first-tier cities, house prices are rapidly declining, even dropping to levels not seen since 2016 or earlier. Real estate, once seen as the safest investment, is now experiencing an unprecedented collapse in credit. Goldman Sachs' latest research confirms this trend. Since its peak in 2021, China's housing prices have fallen by about 20%, and they could drop another 10%, with the bottom possibly not being reached until 2027. Unlike other countries that pump massive amounts of money into their markets to stabilize them, China's government is taking a cautious approach, prioritizing debt reduction and preventing bubbles. As a result, the recovery is expected to be much slower. Real estate has long been a barometer for China's economy, and the rise and fall of real estate agencies reflects the market's condition. In the past, the streets were lined with real estate offices, and salespeople in suits were the most direct signs of the housing boom. However, now, the industry is experiencing a massive shakeup. In Shanghai, well-known agencies are laying off thousands of employees. In the city of Lianjia, layoffs could reach nearly 8,000 people. With second-hand home sales at a standstill, offices are closing one after another. Many agents are switching careers, some are becoming influencers, others are joining the home decoration industry, and some are even becoming food delivery drivers. Once top agents are now on the layoff list. Ironically, former real estate offices on the street are now being replaced by after-school programs, hobby classes, and even small dining spots. Unsold homes are now being overshadowed by a surge in tutoring services, reflecting the dramatic shift from the nationwide obsession with real estate to a national indifference. House prices are falling, which should have triggered widespread social discontent, but surprisingly, the situation has been eerily calm. After years of continuous declines, people seem to have quietly accepted the fact that property values have been halved. Neighbors no longer discuss the massive profits or losses from buying or selling homes, and posts about property data rarely get responses. China's strong self-digesting ability has allowed this wealth shrinkage to be accepted with almost calm resignation. But beneath this calm lies a heavy financial shadow. Around 70% of Chinese household wealth is tied up in real estate. If house prices drop by half or lose liquidity entirely, the wealth of hundreds of millions of families could evaporate, and social classes may be forced to reassemble. Financial commentators warn that the real danger isn't just price drops, but zero liquidity. When houses cannot even be sold at a much lower price, real estate loses its role as an investment, a store of value, and a financial asset altogether. In response to this crisis, the government has started implementing measures to loosen restrictions. Beijing, Shanghai, and Shenzhen have lifted home purchase limits, but the market's reaction has been tepid. Guangzhou removed its purchase restrictions back in 2024, but a year later, prices are still falling, proving that the market rescue has had limited success. Goldman Sachs believes that China's real estate market may require a fiscal stimulus of around $1 trillion to reduce inventory, ensure property delivery, and restructure debt. According to public information, in October 2024, the Chinese government increased the credit scale for unfinished real estate whitelist projects nearly twofold to 4 trillion yuan, about $562 billion. Xiao Yuanqi, deputy director of the China National Financial Supervision and Administration Commission, stated in a press conference that by October 16, 2024, loans for mainland whitelist real estate projects had reached 2.2 trillion yuan. However, even with these efforts, it is difficult to reverse the trends of population decline and slower urbanization. In the future, real estate will rely more on existing stock renovation than urban renewal. There is an iron rule in real estate. Population determines how many houses are needed. The structure and the movement of the population determine where houses are needed most, and bank interest rates and supply elasticity determine how much houses cost. Therefore, population is critical to real estate. Regarding population, in January 2023, the Chinese Communist Party updated national population statistics, revealing a decrease of 850,000 people compared to the previous year. This marks the first population decline in 60 years and is the CCP's first acknowledgement of halted population growth. However, some data suggests that China's population decline is far more serious than the official numbers indicate. In June 2022, leaked data from the Shanghai Public Security Bureau indicated that China's actual population might be about 1 billion. Japan once used China's annual salt consumption to estimate its actual population. In May 2024, Japan published an article titled "Salt Consumption Data Shows China's Rapid Population Decline." According to the China Business Industry Research Institute, in 2022, China's salt production was nearly 50 million tons, a 25% decrease from 67 million in 2019 before the pandemic. In a country where eating is a cultural joy, the sharp drop in salt consumption indicates a significant issue. In December 2024, the International Monetary Fund published an article by American expert Kenneth Rogoff. The article affirmed the contribution real estate has made to the Chinese economy, listing data showing that in 2021, real estate, including both residential and commercial properties, accounted for 25% of China's GDP. If infrastructure is included, this percentage rises to 31%. In fact, China's per capita housing space now exceeds that of all major European countries, even though China's per capita GDP is only one-third of these countries. However, for cities that already have a large stock of real estate, the benefits from new real estate investments are much lower. These cities also face more severe local government debt issues, particularly due to economic growth not offsetting investment costs. Particularly, the housing prices in third-tier cities, which account for about 60% of China's GDP, have been falling. Most home purchases in China are made through loans, with the house serving as collateral for the bank loan used to pay for the property. A drop in house prices reduces the house's value, worsens the household's balance sheet, and reduces borrowing capacity, making it harder to repay debts. This leads to reduced consumption and investment, and under the added pressure may even trigger defaults and deleveraging. For example, consider a house priced at 1 million yuan with a 30% down payment of 300,000 yuan and a loan of 700,000 yuan. The total repayment, including principal and interest, would amount to around 1.4 million yuan. If the house price drops to 800,000 yuan, how much has the homeowner lost? First, the homeowner paid 300,000 yuan as a down payment and 1.4 million yuan for a total of 1.7 million yuan. However, with the house now worth only 800,000 yuan, the loss is 900,000 yuan. If the house price rises from 1 million yuan to 2 million yuan after repaying the 1.4 million yuan, the homeowner would have made a profit of 600,000 yuan. Therefore, a decline in house prices results in asset shrinkage for every household. The real estate market in China also drives the development of industries such as home decoration, home appliances, and furniture. Once prices drop, it could trigger a broader economic downturn, casting a shadow over everyone's career and affecting income levels. Kenneth Rogoff summarized 3 signals indicating that CCP's real estate crisis could trigger a nationwide systemic crisis. 1. The ratio of housing prices to incomes in Beijing, Shenzhen, and Shanghai is nearly double that of London and Singapore, and 3 times that of Tokyo and New York. This means people still can't afford to buy homes, and prices will continue to fall. 2. The alarming speed at which household debt in China is increasing. The household debt-to-GDP ratio has risen from less than 20% in 2008 to over 60% in 2023. This indicates that the real estate crisis is affecting every household in China. 3. Income inequality in China has worsened. Many families own multiple homes, while low-income families may not even be able to afford rent. Social inequality is often the root cause of social unrest. The myth of real estate in the Xi Jinping era has collapsed. Real estate agencies that once shone brightly on the streets have now closed overnight, marking the end of an era. Those who once shouted, "Buying a house is buying the future," are now coldly ironic. People may still quietly accept the situation, but the entire country's economic structure, financial security, and societal mindset have been profoundly reshaped by this real estate crisis. The current situation in China mirrors the conditions seen before political upheavals in many other regions. Taiwan's experience from 1987 to 1989 saw a real estate boom, followed by the 1990 stock market crash, which was then followed by a decade-long market correction. The hot then cold cycle of Taiwan's real estate mirrored the shifting social mindset and voting patterns. Experts note that Taiwan's real estate bubble in the late 1980s and the long-term market clearing in the 1990s suppressed the wealth effect, dragged down employment, and created a financing environment that contributed to the 2000 political party transition. In fact, the late 1980s saw a combination of capital repatriation, financial liberalization, and the stock market myth, resulting in a clear asset bubble. Taiwan's real estate prices surged after government land value announcements, with a 9.74% increase in 1987, an 11.54% increase in 1988, and a 47.3% increase in 1989, before skyrocketing by 103% in 1990. Afterward, the market began to decline. From 1987 to 1999, the average price of homes in Taiwan increased from about 60,000 new Taiwan dollars to 190,000 new Taiwan dollars, tripling in just 2 years. In Taipei, housing prices increased by nearly 4.5 times. The 1990s saw Taiwan's real estate enter a prolonged correction phase of shrinking volume and weak prices, with slow clearing of inventory. This was a painful adjustment process, deeply felt by ordinary people. Taiwan's financial system fell into a negative cycle of asset prices, credit, and employment. The media and researchers at the time often described this as the painful transition from a bubble to maturity. Due to the economic pain, many lost their jobs and income sources. Young people organized street protests, and the voices of dissent echoed throughout the country. This period of economic pain also led to political instability in Taiwan. After Chai Ching-kuo's death in 1988, Li Tenghui rose to the peak of power. Initially, like the Chinese Communist Party, Li advocated for Taiwanese nationalism. However, Li's actions eventually failed to meet the expectations of the Taiwanese people. On March 16, 1990, Taiwanese university students began protesting, expressing dissatisfaction with the National Assembly and its members attempting to seize more power and influence. Li Tenghui responded to the protests and implemented the political reforms that the students had demanded. 6 years later, Li Tenghui was democratically elected president. In 2005, the National Assembly of Taiwan was dissolved. This pattern of political change also applies to Japan. In September 1985, the U.S. government, in a meeting with finance ministers and central bank officials from Japan, Germany, France, and the UK, reached an agreement to coordinate interventions in the foreign exchange market. The countries collectively sold dollars and bought yen and German marks, which then helped the dollar to depreciate in an orderly manner and address the U.S. trade deficit and correct the overvaluation of the dollar. After signing the Plaza Accord, the Japanese yen surged, and large-scale monetary easing and credit expansion pushed both the stock market and real estate prices higher. From 1986 to 1987, the official discount rate dropped to 2%, leading to unprecedented liquidity. The lower the discount rate, the more people are willing to borrow and invest. However, much of the hot money entered the stock market and real estate, leading to the Nikkei 225 reaching a historic peak of nearly 39,000 points on December 29, 1989. Land prices also peaked around 1990-1991, then began a long decline. Research from Japan's Real Estate Institute and Central Bank shows that the urban land price index significantly dropped in the decade following the 1990 peak, which heavily impacted macroeconomic and financial stability. The situation is similar to Taiwan's economic downturn and was equally painful for Japan. After the bubble burst, bad loans continued to rise. In the fall of 1997, securities and banks collapsed, and the central bank was forced to intervene to maintain settlement and liquidity, which eroded public confidence. In this context, saw the Japanese Liberal Democratic Party LDP lose power for the first time. The party experienced an internal exodus, prompting another electoral realignment. After the July elections, the LDP lost its majority in the House of Representatives, and a coalition government led by Morihito Hosokawa of the 8-party coalition took office. Academics generally view this economic crisis in Japan as a symbolic event, marking the weakening of the 1955 system in Japanese politics. Commentators have summarized that both economic slowdown and corruption jointly weakened the legitimacy of the long-ruling government. After the last 3 decades, Japan's economy remains weak, and voters have given the opposition party a chance. Li Tongrong, an expert on China's real estate market trends, openly stated that the collapse of the Chinese property market was caused by excessively frequent and improper regulation. He also predicted that the real estate market would go dormant for 5 to 10 years, losing its leadership role as the driving force of the economy. Most external observers believe that the domino effect triggered by the Chinese real estate debt crisis will severely harm the economy, making it difficult to recover. Even Standard & Poor's predicts that 1/3 of China's real estate developers will collapse. Chinese economist Fu Peng believes that the biggest problem China faces is the debt crisis brought on by the economic crisis. After studying Japan, he analyzed that the success of Abenomics was due to the large number of elderly people passing away, which caused a sharp population decrease. This, in turn, led to an unprecedented level of personal wealth distribution. Fu Peng believes that for China to achieve similar prosperity, it needs to figure out how to move money from the pockets of CCP elites into the hands of ordinary citizens, so people don't suffer during the economic adjustment period and cause social unrest. However, no one dares to reveal the true amount of debt. Fu Peng only stated, "The post-80s and post-90s generations have no hope. They're already dead while alive." He implied that these younger generations will continue to pay off debts for previous generations until they retire or even die. A person born in 1999 is 26 years old this year. They will work for 34 years until 2059. China's average life expectancy is 75, so someone born in 1999 will live until 1974. Based on this, how much debt does Fu Peng refer to? We can estimate using the following formula. According to publicly available data, the Chinese government's income in 2024 is 21.97 trillion yuan, with a growth rate of 1.3%. If Fu Peng's claim is true that the post-80s and post-90s generations will be paying off debts until they retire, then in 34 years, the total government income will reach 938.8 trillion yuan, or approximately 130 trillion US dollars. If Fu Peng claims that this generation will pay off debts until they die, the debt amount will be 1,492 trillion yuan, or approximately 209.5 trillion US dollars. In comparison, the total US debt as of the end of 2024 is only $36 trillion. The collapse of Taiwan and Japan's real estate and asset bubbles, along with prolonged deflation and financial instability, weakened the ruling party's sense of governance and public expectations, providing the critical economic backdrop for regime change. Meanwhile, internal party fragmentation, corruption scandals, and other political factors contributed to public dissatisfaction, leading to social unrest and political upheaval. Now, the CCP is only left with 2 options: life or money. They're arresting corrupt officials and filling the debt holes, using the pandemic as an excuse to reduce the population, adjusting wealth distribution, and clearing out both population and assets.